The debt service coverage ratio, or DSCR, is a long-standing metric in the commercial real estate space that over the last decade has been applied by non-conventional or non-QM, non-qualified mortgage residential real estate lenders. This is simply the rent payment divided by the mortgage payment. Technically, it is the rent payment divided by the total of the monthly mortgage principal and interest payment, the property taxes and hazard or homeowner's insurance, whether you escrow or not, the flood insurance if required, and homeowners association dues if any. So for a residential investment property purchase, the rent amount will be obtained from the comparable rent schedule, the 1007, a supplemental form provided along with the regular appraisal, or from an actual lease agreement. For the purposes of a refinance, if the property has been owned for more than 2 years, then the rent amount will be obtained from the Schedule E of the borrower's tax returns. Basically, if the rent is more than the payment, then the ratio will be greater than 1 or equal to it, and the property is typically considered cash flow positive. However, it still may not be cash flow positive because what is not evaluated by this ratio is any loss of rental income when the property might be in between renters, referred to as the vacancy rate, nor does it take into account any maintenance, repairs, insurance deductibles, or any potential increases in property taxes, insurance, or HOA or condo association dues. The DSCR ratio can certainly be a useful tool for non-investors as well. At the very least, it can be used to evaluate whether or not the purchase price is reasonable. Similar homes for rent in the neighborhood can provide an indication of rent. But even better, the DSCR can solve the biggest flaw and mitigate some of the risk when relying solely on the debt-to-income ratio when determining an ability to repay. Consider a borrower who loses their job, whether that is the day after they close on a purchase of their primary residence or years later. Without or before exhausting all of their savings or reserve funds, they may be much better off renting what had previously been their primary residence rather than being forced to sell, and certainly better than defaulting on their mortgage. So prior to purchasing, if the debt service coverage ratio is considered and the property is cash flow positive, then the borrower may be able to avoid foreclosure and hold on to that asset regardless of what unfortunate things might happen.